So we skipped objective 5, so we're going to jump straight into objective 6 and then finish up with objective 7. So let's look at how the equity is reported for a corporation. So we've looked at the statement of retained earnings before. Remember that dividends declared account, or that cash dividends account, or the dividends account, however it's being called. This is the same dividends account that we debited when on the date of declaration when we recorded the dividend. So that shows up on the statement of retained earnings. Now, there is an option that GAAP gives us of reporting what's called a statement of stockholders' equity. It's essentially an expanded statement of retained earnings. IFRS requires the statement of stockholders' equity, so we're seeing it more and more on U.S. financial statements as well. Since they're having to do it for IFRS, they might as well do it for U.S. GAAP. U.S. GAAP doesn't require it yet, but again, most of the companies that I'm seeing are already doing this kind of expanded statement of retained earnings, the statement of stockholders' equity. So just look at it here. The statement of stockholders' equity essentially lists the changes in all of the stockholders' equity accounts. So we see our common stock accounts, we see our paid-in capital in excess of par, and then if we had preferred stock, that would also be here. This company, Mountain Home, doesn't have preferred stock. And then we see our retained earnings. So the retained earnings column, this column is essentially our statement of retained earnings. And then we've just added in the other columns, the other accounts that appear in the statement of stockholders' equity to kind of give a more comprehensive overview. Now we can see we had beginning retained earnings right here. We had net income. We subtract dividends. That gives us our ending retained earnings. This prior period adjustment. What this is we talked about this a little bit back in chapter 6 when we talked about the consistency principle. So remember, the consistency principle says we have to use the same method of accounting every year. If we do switch, we have to go back and restate those prior years. There's going to be a change. There's going to be some sort of mass change when you switch from, like, let's say FIFO to LIFO. That's just one example. There's a lot of things that may cause a prior period adjustment, but ultimately that adjustment's going to wind up in retained earnings. So let's say that switching from LIFO to FIFO caused us to have a $10,000 loss. That's going to be reflected here in retained earnings. Now, there's two ratios that I want you to be familiar with that pertain to common stock and stockholders' equity. The first one is earnings per share. Now, earnings per share is required, mandated to be reported at the end of the income statement. So when you look at a company's annual report, at the bottom of their income statement, they are going to list earnings per share. Essentially, what earnings per share does is it reports the amount of net income per share of common stock. So it breaks down this dollar value bias because companies have a ton of income, right? And we're like, oh, they made a $4 bazillion last year. I don't know. That's a whole lot of money, right? So we break it down by common share. It gives us a smaller amount. It's a little more easier for us to understand, and it allows us to compare over time. How's our earnings per share doing over time? So to calculate earnings per share, and we're given some data for Kohl's Corporation, you're going to take the net income for the year minus any preferred dividends. So earnings per share is only reported for common stock. So if we paid any preferred dividends, we subtract that out. If we didn't pay preferred dividends, then that's just zero, like in the example here, so we don't have to subtract that out. And then we divide it by the average number of common shares outstanding. Okay. So in the example of Kohl's, they did not pay any preferred dividends, pardon me. The average shares outstanding is last year's shares plus this year's shares divided by 2. So their earnings per share was $4.84. Now, one thing that I want to caution you for, we can compare Kohl's earnings per share this year for 2019 versus 2018 versus 2017 and go on and go back. We want to see the earnings per share remaining stable or ideally increasing. What we don't want to see is it decreasing, okay? You cannot, however, compare earnings per share for two different companies. The reason is that denominator is the average number of shares outstanding. If one company has more shares outstanding, they're by definition going to have less earnings per share just because they're older and have more shares outstanding. So we can't compare two different companies. We can use it to compare the same company over time, though. Now, if we want to compare two different companies, what we're going to use is called the PE ratio, or the price earnings ratio. This incorporates the market price, the selling price on the stock market of the company's stock. So what this tells us is how much an investor would be willing to pay for a dollar of earnings. How valuable do the investors view the earnings? So if we assume that Kohl's had a $65 stock price, then we would take their $65 stock price divided by their earnings per share, and we get 13.43. Now I can compare this with other companies. So the higher the PE ratio, the better. So we want a high earnings per share, but we also want a high stock price to go with it. So by using the PE ratio, we can now compare two different companies.